Online, just confirm. Can you hear me and can you see my screen? I was having problems, connection problems lately, so just confirm. Can you hear me and can you see my screen?
Yes, we can hear you and we can see your screen.
Okay. So most of you, Munemosa, if not all of you, because I don't remember getting a response, which is something worrying because as I open your slide, it's showing that the last thing there was an assignment and it's written Wednesday, but I don't remember getting the response there. So please do attempt so that at least when you're now revising, it helps you pick where you might be making errors. Because if you think you can do it alone, it's very risky. You can be doing it the wrong way. You do need my assistance, especially with the responses, how you are going to respond to the question. You might have the knowledge, but you might fail, not necessarily because you did not know the things, but because you failed to apply what you know. So it's very important that besides just you going through the content of the syllabus, you do practice and you do have your work marked so that at least you know where you need to improve on, you know where you might be facing challenges. So in the last session, we're looking at corporate governance, and I think there's just there are just few concepts we had not talked about that I want us to just clear up. Then we start the revision of the work that I gave you last time. Uh, Hopefully, you did attempt and you just forgot to submit. That's what I'm hoping. If you did not attempt, then we are heading for disaster. And that's not a secret. So please make sure you do attempt the assignments. Okay, so let's finish up. The last thing that I'm talking about is on corporate governance. So the last thing we were discussing, it was on corporate governance. And on corporate governance, the thing that we had not talked about are just the committees. Of course, we had highlighted the committees that we have, but I think we needed as well to talk about these committees in depth. So we just talked about these committees. We listed the committees that the entity needs to have, but we did not go as far as talking about each committee, what it does. We did not go to the extent of talking about each committee individually. Okay, so let's start with the audit committee. So we'll talk about the audit committee then. Yeah, I think another issue is internal auditors. So this shouldn't take us time because my main aim today is to get into the revision questions and see how we are supposed to attempt. Maybe for today, we'll just talk about the section A because we have been maybe discussing issues which mainly affect the section B. That is, we have been talking about audit risk, controls, all those issues. Of course, they can be asked in the first section, but they are mainly going to be found in the second section. Okay, so from the audit committee, I think from the committees that we listed, the main one is the audit committee. That's the one that is likely going to be part of your section A. They can ask you the structure of the audit committee. They can say what improvements might be needed from the members that are in the audit committee. Because we're doing auditing, so audit committee is one of the committees that we want to understand more about. So let's have the audit committee. I think for the other committees, I can read through those. they are not that important as compared to the audit committee. So for the audit committee, it is made up of non-executive directors. So the audit committees, it must be consisting of those directors who are independent. So they can say they are different members who are whom we are proposing to be part of the audit committee members. Someone who should be in the audit committee should be, number one, someone who is a non-executive director. Not just that, it should be someone who is independent. So the audit committee, it comprises of non-executive directors. It comprises of non-executive directors who are independent. It comprises of non-executive directors who are independent. So it's not just about being a non-executive director. You should be independent. The key principle is you should be someone who is independent. And the audit committee, this is the committee that oversees the internal audit department. So you can say they oversee the internal audit department. So the internal auditors, they report to the audit committee. As an internal auditor, for me to report direct to the management, because remember, internal auditors are assigned to go and verify whether the controls are working well. Then they have to report internally to the organization. So the challenge now comes if I'm being asked to report in the organization to those who are my superiors and also those that are responsible for the systems that I have been verifying. So ndaenda unzi ndinocheka the system that my superior prepared. Is the system working well? Then you come and give feedback. There is a lot of intimidation there. For me to come back and say the system yamakagadzira mudhara haishande, there is a lot of intimidation there. So in order to avoid that, we need, of course, they can be assigned by management, but they can report to the audit committee so that if at least the non-executive directors who are in the audit committee, they can then take the issues to the board. So instead of the employee taking the issues to the board, at least they can be now coming from the audit committee. At least that will at least lessen the intimidation threat there. Because the non-executive directors in the audit committee will not be afraid of the executive directors running the company. So they oversee the internal audit function. And in most cases, they are the ones that can actually advise that the organization does need internal auditors. So the organization, if it's still small, we can run cinema internal auditors. But as the organization grows, we need the internal auditors. So it is the audit committee that can advise the need for internal auditors. They can advise the company that it's high time that the internal audit function must be created. Then now let's move on. Besides that, they also monitor the audit committee. They monitor the external auditors. They monitor the external auditors to ensure that they monitor the internal auditors to ensure they conduct their work in accordance. They conduct their work in accordance with the ESAs. So external auditors, they don't take orders from the company, but do they get monitored? Yes, internal auditors are supposed to carry their work, independently. They're supposed to be doing their things properly, but do they get monitored? Yes. Who monitors them is the audit committee. So audit committee, monitors my external auditors. Of course, they can't say you're not doing well, so you should stop right away. But they do provide a recommendation to the shareholder. So the audit committee can then recommend the shareholders to say, the auditors that you hired, did they do a good job? Because the audit committee will be watching what the external auditors are doing. So if they think the external auditors are not doing their work well, they are able to report that to the shareholders. So the audit committee, they also watch the external auditors. They watch what the external auditors are doing. Then besides that, they recommend, I think we've talked about that. They recommend the need for the internal audit department. We can say they monitor, the independence of both internal and external auditors. They monitor to see whether the auditors are carrying out their tasks independently. They monitor to see whether the auditors are carrying out their tasks independently. So on that same note, let's talk about, we have mentioned internal auditors. So last time I did talk about internal auditors in passing. So internal auditors. So the internal auditors in the organization, the internal auditors, these are assigned mainly to verify the control system. They are assigned by management. They are, so they are assigned by management to verify if the control system is working effectively. So the internal auditors, they are assigned to verify if the internal controls are working effectively. So their duty is to ensure that if we have designed the controls, the systems which we use to prevent errors and fraud, are these controls working effectively? And after they have verified whether the controls are working well, they report their findings. They report their findings to the audit committee. They report their findings to the audit committee. Then it is the audit committee that will carry forward those issues to the board. The audit committee then escalates the issues to the board. So the audit committee then escalates the issues to the board. Now let's move on. I think another issue to take note of, we can talk about the characteristics of an effective internal audit. So even though they are internal auditors, they are reporting internally, they need to be independent. So again, if we are choosing members to be part of the internal auditors, they have to be chosen from people that are independent. So the first characteristic is that they need to be independent. So the first characteristic is that if we are internal auditors, we have to be independent. Number two, the internal auditors, they must have professional competence. So they must have professional competence. So the professional competence, this is having the knowledge of what they're expected of doing. You can't be an internal auditor who doesn't know what you have been assigned of doing. So it's not just about taking any employee. So it's actually an area that someone can study. You can do internal audit. So we can hire people that have studied along the lines, not just any employee. It should be someone who is competent in that field. And for us to have an effective internal audit department, there must be an appropriate reporting channel. A reporting channel. So there must be an appropriate reporting channel. So by appropriate reporting channel, this means that the auditors should not be required to report directly to the management, but we should have the audit committee where they can report to. So they should know where to report to after they have carried out their internal audit. And the person whom they should be reporting to shouldn't be someone who intimidates them. So there should be an appropriate reporting channel. Then the benefits of having internal audit. Benefits of internal audit. So the benefits to the entity of these internal auditors, they can help us to quickly detect. So before it's started on better external audit, internal auditors can help us figure where the systems are not doing well. They can help us detect errors and fraud in time. So early detection of fraud and error. So early detection of fraud and error, that's the first one. Then also the internal auditors, they watch the control system. So they ensure that our control system is working well. So we can say they give assurance that the operational environment is working effectively. Operational environment is working effectively. They improve risk management. So an entity in a internal auditors, they are likely to be prepared for risk because tagara taudzwa ma-areas kunenge kuchileka. So we are likely to address my risks in time than if an entity doesn't know what's taking place, they don't verify the systems, are they working well? So we tend to be slow in responding to risk. But in the presence of internal auditors, we can quickly respond to risk. The organization can quickly respond to risk. And lastly, it can increase stakeholder confidence. increase stakeholder confidence. So the stakeholders of the business, they are going to use the audited financial statements to make various decisions. So they are likely to have trust in the entity when there is both internal and external audit being carried out. They know this entity, errors are quickly identified. Let's talk about the limitations. The limitations of internal audit. So the problem with internal auditors, you can't rely on internal audit only. Why? Because for internal auditors, they don't verify every area. So the scope of the audit will be limited. The scope of the audit is limited to specified areas. So internal auditor doesn't just go and audit anyway. They are told which areas to go and audit, unlike an external auditor. So internal auditors, they have a limited scope. They don't just audit any area. They are restricted to the areas which they have been assigned. So the scope of the audit is then limited to those areas. Next, also the staff, because we have to use our employees to carry out the audit. The staff may lack necessary skills. So the audit team that we are auditing with, the people that we are assigning to do the job, they might lack the skills because we use our employees who might not have the required knowledge to carry out the internal audit. So that is the other problem. Then lastly, may lack independence. May lack independence. Because remember, there will be employees of the same company and they're auditing the systems of that company that are prepared by the people that they know who may be from that same company. So they may be afraid of, so the level of independence there is going to be limited because these could be friends that have prepared the systems. These could be, so it could be the system was prepared by your friend, the system was prepared by people whom you are close to, or you might actually be involved in the system. So you don't want to bring out the weakness. So these are some of the limitations. Then the audit function, we can use our employees or we can outsource the audit function. So the internal audit can also be outsourced. So the internal audit function can also be outsourced. So if you are outsourcing the internal audit function, you are hiring another firm to do the internal audit for you. So hiring another firm to do the internal audit for you, it is the advantage that you get someone, if you hire a firm to do the internal audit for you, you get a firm that's independent because these are not people who are working within the company. If you hire someone to do the internal audit, normally those firms that provide internal audit services, they are specialists in the area. So they might have equipment that you do not have because you don't specialize in internal audit. There is certain equipment you might not need to buy or certain people you might not need to hire that you can find if you are to use an outsourced internal audit. Then if you also outsource the internal audit function, you are likely to cut on costs because you only hire them when you need them. So there is no need to set up an internal audit department that needs to be paid. You just hire them when you need them. But the challenge is that outsourcing the internal audit function, it gives us less control over the internal audit. And number two, outsourcing the internal audit, we are likely to demotivate our employees, especially if there was an internal audit department and we have to close it and use the outsourced one. So it can end up demotivating those Vangawarim organization that the organization doesn't trust them or feel they're competent enough. So now let's move on. I think these are all the key issues I wanted to highlight. If there are one or two things that were missed, I'm sure we can come through them, we can come across them through revision, and you can also come across them as you revise. There is no harm to come back and ask where you might feel you are not getting. So now let me get to the practice platform. Allow me to just open the practice platform. Okay, so I had requested that you do the practice exam one, which is the one which I have opened right now. So for those who have not written any audit exam before or applied skills exam before, please, you can go through these instructions before the exam. These instructions are the same instructions that you get on the date of the exam. So for these instructions, they will give you time to read through the instructions. But completing these instructions faster doesn't add any time to your overall exam time. So these instructions, of course, they can give you maybe 10 minutes reading time. So it's good you get to the exam knowing the instructions, but it doesn't mean if you don't read them in the exam, there is any additional time you get. What can it save you? It can just save you from the need to feed your mind with a lot of data in the exam date, because what you're just focused on in the exam date is to download the information that we have onto the paper. So there is no need for us to stress ourselves going through these instructions and trying to understand all that when we can do it now. So you can just go through it so that on the exam date, you don't need to stress yourself on that. So let's move. And as you practice, you'll be getting this screen in almost all the exams. So I'm sure you'll be familiar with it. But for your practices, you realize some of the questions, they are just section P questions. But the one that I have chosen has both sections, section A and section B. So let's look at the structure of your exam. So the structure of your exam, the exam is divided into two sections. So we have section A and we have section B. So for section A, there are just three cases. So your exam will be consisting of cases. So you'll be given a case, then there are questions following the cases. So for section A, we have 3 OT cases. So for section A, there are 3 OT cases. So the 3 OT cases, each containing a scenario with 5 questions. Making up 30 marks. So section A is equally important. 30 marks in an audit exam, it's a lot. And if you can master the section A and score above half, then there are high chances for you to pass. So please don't just focus on the audit risk and neglect the section A as well. So make sure you do give it also the practice that it deserves. Because a lot of people tend to neglect the section A. The section B has 70 marks. The section B has 70 marks. So there are two sections, section A and section B. And the section B, the 70 marks will be coming from 3 questions. So you get to see this as you practice. Now let's get started. You are an audit senior of V company. So they have indicated your position. We are conducting the audit and you are the senior. And you are currently conducting the audit of P company for the year ended 30 June 2026. So that's our year end, 30 June 2026. Let's move on. Materiality has been set at 50,000. So materiality, is this amount necessary or is this amount not necessary? So if the amount when carrying out an audit, the auditors are concerned with material amounts. Auditors are concerned with material amounts. So materiality, it can be based on what? The materiality could be based on the revenue. So if it's above 0.5% of revenue, it's material. It can be based on total assets. If the amount is above 1% of total assets, it's material. The materiality can be based on profit. So if it's above 5% of profit, is material. So these are general. These are general materiality levels. But we have, the performance materiality. The auditor can then say an amount which is 0.5% of revenue is material. But since the auditor is not calculating all the revenue, the auditor is just working with samples. So kanandati 0.5% of revenue is material. Pandinenge ndakutora my figures. Says when ndisina kutora all the revenue, ndangoshandisa a small sample. It means I have to lower down my materiality. I can't say from the sample it should be 0.5. No. If I'm using a sample, I lower down my materiality levels. These are general materiality levels, provided maybe we are auditing all the revenue. But if we are dealing with samples, The auditor can, yes, use 0.5, or they can set a materiality level which is lower than the general materiality level. That is called the performance materiality. This is a materiality level which has been set at a level lower than the general materiality. So the performance materiality, tinaita set our materiality level lower than the general materiality. Okay, let's go back to the case. Materiality has been set at 50,000. They have not highlighted a basing on what, and you are carrying out the test of details on the year-end payables balance. So we are testing the year-end payable balance. The audit manager has emphasized that understatement of trade payable balance is a significant audit risk. So the audit manager, you are an audit senior, but the audit manager has emphasized that my trade payables, they have a high risk of understatement. Below is an extract. Below is an extract. Let's read the case then. So below is an extract from the list of the individual supplier balances as at 30 June 20x6 as recorded by P Company. So these are the suppliers from the list of suppliers. These are the balances at the end of the period. And corresponding balances on the supplier statement. And corresponding balances on the supplier statement. At the same date, along with some commentary on the notes. So these are suppliers that our client is owed. So the first supplier is C Company. So C Company, in our books, we are saying we are owing 50, but the supplier statement is showing 70. So Maria tatarisa kuti isusu yatanyora kuti we are owing is different from what the supplier is saying by something like 20. Lily Company, we are saying we are owing 105, but the supplier is saying no, it's 175. There's a difference of 70. Okay, what has been said? C Company, the difference in the balance is due to an invoice, which is due to an invoice which is under dispute due to faulty goods which were returned on 29 June 2018. So we are saying isusu takadzosera magoods. Ivo vachiri vakarekoda chikweret, it's still being disputed. It's takadzosera magoods, but ivo havana kubvisa chikweret. So which is what is causing the difference? And which is what is causing the difference? Then we have Lily Company. The difference in the balance sheet is due to the supplier statement showing an invoice dated 28 June 20x6. So the difference in the balance is due to the supplier statement showing an invoice dated 28 June 20x6 for 70,000, which was not recorded in the financial statement until after the year end. So Tangatsatita recorded this invoice. The payables clerk has advised the audit team that the invoice was not received until 2 July. So takanonoka kureceiva the invoice. Ivo vanga vatorekodha chikwereti, isusu tanonoka kureceiva the invoice. So, okay, that is the case. Now let's go to the questions. The audit manager has asked you to review the full list of trade payables and select balances on which the supplier statement reconciliations will be performed. So, handitsvaga balances where we think we need to make reconciliation. So, takapiwa maybe different balances, and we have to pick on which balances do we need to reconcile. So, the balances where we need to reconcile are those with potential errors and those with potential fraud. So we don't just reconcile, we reconcile because we are suspecting that this could be erroneous, or we are suspecting that they could have been fraud. So there's the first one. Track select the amounts for reconciliations. Track select the amounts for reconciliations. Then the first one is saying that suppliers with material balances at the year end. Should we include or should we exclude? What do you think? We are picking items to reconcile. So suppliers with material balances, should we include or exclude? Include. Why? Because it's material. So as long as an amount is material, the auditors are interested in that amount. They want to understand. And those with material balances we include. Suppliers which have a high volume of business with P company. Those online, please help me as well. What do you think? Should we include or should we exclude? Mukundigno. Math.
I think we should include them.
Yes. A high volume, it goes with material. So if there are high volume of transactions taking place, that is likely also going to be, it means my errors can take place. Because of the frequency of the transactions, we can make errors. So those transactions with a high volume or high traffic, they are material, they are prone to errors. Major suppliers with new balances at the year end. They are major suppliers and they're not owing anything. They have new balances at the year end. Major suppliers with new balances. So major suppliers with new balances we exclude because we can't include them if kana zviri kuenderana. And so the reason why we need to reconcile is because we are suspicious that there could be errors. And so if at the end of the year we don't have any balance, then there is no need. Then major suppliers where the statements are agreeing. So major suppliers where the statements are agreeing. What do you think? But sorry, I'm thinking this one. If they are major suppliers, the reconciliation is just to verify. So for these ones, because they are major, being major, it makes them material. So if they are major suppliers, it means they are material. But if major suppliers where the statement are agreeing with the ledger, because the question is not saying zviri kuenderana, zvangozi they are new balance. So it could be isusu mafinancial statements edu zviri kuratidza kuti pane havasi kukwereta chinhu, hatisi kukwereta in fact, but isusu ivo vari kuti tiri kukwereta. So having a balance of zero doesn't mean it's agreeing. So as long as they are major, it means they are material. But zvasiyana manje this statement riri kuzoti manje major suppliers where the statement agrees to the ledger. So where the statement, the supplier statement is agreeing with what you have recorded, then in that case, we exclude. Because having a new balance, it doesn't mean we agree. So let's move to the next. Okay, try this one. What's your take on this? Please, let's be fast.
I think that we should review the post-year end cash book for evidence of payment of the invoice. Since they stated that the 70,000 was not recorded after year end because the invoice was received after the year end.
So your answer is review the post year, that's C.
Yes, see, that's what I think.
Are you all agreeing with that? Review the post year and cash book for evidence of payment of the invoice. Okay. I think what determines its inclusion in the financial statements is when did we receive the goods. So I would go with A, and I'll talk about why I'm not going with C. Because the issue is not about the payment here. It's about recording the payables. What if we received, yes, that's it after the year, but there is no rule, so issue is about recording the invoice, not when was it paid. So checking the cash book, we might not see the payment in the cash book, but does it mean kuti, because chikwereti guys, it's not actually a cash payment that was made. So kana chiri chikwereti, we can say yes, tazopiwa invoice gore radarika tikabva tarekoda, but hatina kuita payment. So in the event yekuti hapana kuitwa payment, the cash book will not reflect. But even if the cash book ikasa reflect recorder, it doesn't necessarily mean kuti, because what we are looking for is not the evidence of the cash payment, it's the evidence of inclusion in the financial statement. So I guess that one would work if our argument was that takabadara, but the question was not takabadara, taka receive an invoice after the year end. And receiving an invoice, we don't record in the cash. Do you support me, Martha, on that?
Yes,
Please do
I
support.
support.
Okay. So what am I suggesting here? Inspect the goods received not to determine when the goods were received. Because yes, they said invoice yazo yagorapera. Kureceive invoice after the year end. Should not determine when should we record. It's when did you receive them? When did you get control over the goods? You account for the goods when you get the control. So Kanamaga receiver the goods gore satrapia. It means you should have included that in the previous year. So if an adjustment has to be made, we can say maybe that's an adjusting event. But which of the following procedures should be performed in relation of the balance to determine if they are understated? Because what you want to verify, the ratio type of understatement here. So tikaona kuti magoods akareceive last year, but ratio now record, so it's an understatement. But kana goods received not, iradzo zvakazouya gore rapera, musi wa2 pakainvoice ndo pakauya magoods, then it was not understated. Anita? So I would go with the first one. On the basis, yekuti tida kuverify kuti have we not understated the payables balance? And could it check whether we understated tofanira kuziva kuti tanga tamboreceiva magoods aya. Okay, let's move on. If you see this notification in the exam, it means you have not scrolled. So you just scroll down the scroll bars, the sidebar as well. Means there is this side run goes no Fridays. Which of the following audit procedures should be carried out to confirm the balance owed to C company? Robert watregerera wanyaya kunyarara. I'm not saying Robert only should answer. Even you can also. Oh. Hey, are we winning? Two and three, that's the first one. Let me go through it. Okay, let's do it together. Sorry for that disturbance. So which of the following audit procedures should be carried out to confirm the balance owing? To confirm the balance owing. To confirm the balance owing, review the post year. What do we want to confirm is the balance owing to C company, okay? Review the post year end credit notes for evidence of acceptance. If Kanaka accept, just a moment, can I answer that? Mm. So that you want to do the data. Yabo, nditwa tisasiyana. Iri bongo, nimulese. So let's proceed. Shukuti so confirm. Let me just go back to the case. But I still remember, and C company, what was the issue with C company? C company, Papa in a dispute. Is it? Let's go back. So C company, what was the case? Yes, C company, there was a dispute. So takadzosera zvinhu kuna C company, ivo ndobva varamba vakatinyorera chikwereti. So we want to confirm the balance. So kana takazowirirana kuti zveshuwa zvinhu ngazvidzokere, it means isusu tatisina balance yedu yanga iri kure. But after kana tikazonzi takawirirana kuti no, hapana zvinhu zviri kudzoka, it means balance yedu yanga iri understated. So review the post year and credit notes for evidence of acceptance. Yes, because if they have accepted, they will issue credit notes. Then inspect inspect pre-year end goods returned not pre-year end before the year end in respect of the items sent back to the supplier. Inspect the post-year end cash book for evidence that the amount has been settled. Again, I'm condemning the three. Because again, it's going back to the issue of the cash book. Because this was a credit transaction with our payables. And so it's not necessarily the case that if they accepted, what should happen is kana vakaaccepta chikwere vanotirejisira chikwere, because it's not an evidence yepayment yakaitwa, it's an evidence yekuti vakabvuma here kuti magoods adzoke votidzikisira chikwere, because the payable is chikwere chete. So I'm going with 1 and 2. The third one, I'm condemning it on the basis of us verifying via the cash, because this one is not necessarily a cash payment. This was a credit transaction tatenga nechikwereti tikazidzosera, so vaifanira kurejisa chikwereti chedu. Do you agree with me? Please, you're allowed to say out your mind. Oh, maybe we can. We can also select so that if we get a chance to review the answers, we can do so. Please quickly try this. I don't want to spoon feed you, just have a minute to go through that, think of your answer, then I tell you mine. So what's your answers, please? Let's move. A. So the audit manager is asked you to review the results of a test based on statistical sampling, which resulted in 20% of the payable balance being tested. The testing results indicated that 45,000 in error in the sample, 20,000 which was due to invoice being recorded in the correct period as a result of weak controls, and one off error of 25,000 which was made by temporary clerk. What would be an appropriate course of action on the basis of these results? There's no further work required. A? No, really. This is a sample. You are reviewing a sample. What's the purpose of a sample? A sample is supposed to be used as a representative of the total. So I would go with B. The effect of the control error, the effect of the control error should be projected across the whole population. We should assume that if these are the results of the error, if there was a 20% error in the sample, the assumption is that the whole population also has that same percentage of error. So if you take a sample and there's an error in the sample is supposed to be a representative of the population. So if there's an error in the sample, we should assume that that same error is also existing if we had calculated the whole population. So if there's a 10% error, we'd assume even in the whole population. If there's 1% error, we'd assume even in the whole population. So the effect of that error should be projected to be existing across the whole population of the data. Because the purpose of this sample is to be a representative of the population. Let's try this. Those online, Mandregere. Which of the following is test data? I think test data, we did talk about this one as well. The CAAT. So kana waisa tero stars na basa mino.
Mm, I think I think I D is the answer. Inputting dummy pictures invoice into the client system to see if processed correctly.
Do you agree with here? Yes, that's correct. So test data you're inputting, it has to involve inputting dummy data. Different. So we input dummy data. So that I do agree with that. Let's. This is now a new case. So let me give you time to read through that. I'm also going through it. Please quickly read through that. Are you done? Let's now do the questions together. Okay. The first question. B company has a responsibility to perform procedures to obtain sufficient and appropriate evidence that subsequent events are appropriately reflected in the financial statement. So I think we did talk about subsequent events, the events after the reporting period, but before the financial statements have been signed by the auditors. Indicate by clicking on the timeline up to which date the auditor should perform subsequent event procedures. Up to when? The auditor should perform subsequent event procedures up to when? Sorry? It should be the date of the auditor's report. So, of course, up to the date of approval, our Botany active. But from that date, we still have a passive responsibility. So, until we have signed the report. So, it's up to the date we have signed the auditor's report. So, once we have produced the auditor's report, then Dobanos opera our obligations. As long as we have not yet produced the auditor's report, we still have a duty. Let's try this one. Okay, let's move on. So, which two of the following are appropriate actions? If after the financial statements have been issued, the company becomes aware of a fact which may have caused its report to be amended, the firm should consider several possible actions. Which two of the following are appropriate actions for B company to take? Which are the appropriate actions to be taken by B company? Denzel is saying A and D. Richard, are you in? Marva, what's your take?
A.
So discuss with the management and those charged with governance. I think this one goes, obtain a written representation letter from management, consider whether the firm should resign. Not really. Also, we need to inquire how they intend to deal with the issue. So yes, I go with the first and the last. I'll go with the first and the last. Let's move on. Which of the following audit procedures is not, take note of not required to be performed to form a conclusion as to whether the financial statements require an amendment in relation to unfair dismissal claim? So which one is a procedure is sort of the ideal? Which procedure is not ideal? Are we winning? So which of the procedures is not required? Can you try at least, please? Okay, Denzel is saying C. I don't know if you can support it or I'm going to that C. Okay, those online, what's your check? So which of the following is not required? I think the the second one is not ideal. Why the second one? So the director is the one that is suing the company. And we go and ask the director to confirm what is the claim, do they think the claim will be a success? Ndiwo Ruswa company, then Osco Bunzonzi, they will obviously say, no, company jikiwa, and I will get my money. So they are less likely going to tell you the company will lose. So the director is not the ideal person to ask why. They are directly involved. They're an interested party. They will not give you an independent opinion. You can ask the lawyers, yes. But the director, asking the director in this case, they will not be an independent person because they have interest in the case. Yes, sir. So the director is not independent in this case. Of course, yes, evidence from third parties, but in this case, this one is an interested part in the case. So they are less likely going to give us an independent opinion. You are drafting the auditor's report. And so the key audit matter paragraph. So the key audit matter. So the key audit matter, the matters which require the auditor's attention. So I think from the points here, the most appropriate, it's not all matters, but those that are significant, that require the auditor's attention. So matters which require significant auditor's attention. Not all material matters, otherwise we'll write everything. But we want those that are of significant impact. So it should be matters that have been dealt with properly, but which the auditor feels these ones where they require more attention. If for the auditors, audit they need to pay particular attention to these issues. They have high risk. Which of the following audit opinion will be issued if unfair dismissal case is not adjusted for or disclosed in the financial statement? So which of the following audit opinions will be issued if unfair dismissal is not adjusted? So the issue here is if it's not adjusted for. So if it's not adjusted for, no, it's not about it not being adjusted for. How much was the amount in concern? Is it significant or is it not significant? The case was for 150,000. Can someone calculate for me as a percentage? They've given us this amount, they could be. The director has decided, we can say, we can express it as a percentage of profit or even as a percentage of sales. So let's express it as a percentage of profit. In engage, 150 is a percentage of 6.5 million. Two 2.3, that's less than 5%. What about if you had to express it as a percentage of the revenue? 0.23%. Again, less than 0.5. So this one is not a material issue. So it's about materiality. So the auditors are going to modify their opinion if it's a material mistake. So because of its materiality, I'm sure that's the reason why they gave us the sales and they also gave us the profit. So the amount is an immaterial. So provided that's the only issue, they will not modify their opinion, provided it's the only issue. Unless if there are other issues, then they can aggregate. But if it is the only issue, then they will not modify their opinion. In relation to the composition of the current audit team, from there I had the audit team does not have the knowledge for the particular industry. So in relation to the composition of the audit team, the fundamental principle of what is at risk there. What can we say is at risk? So if you read the case, the audit engagement partner, no, that's not the point. Yeah, only the audit senior has experience of auditing a company in this specialized industry. So that is a threat to professional competence. Professional competence is having the know-how of how to do the audit, how to carry out the task. So having professional competence is having the knowledge expected of you. So if we don't have if it's only one person who knows, then there's a threat to professional competence. And what should we do in that case? Where only, you can maybe reread that point. Starting from only the audit senior. Okay, so what do you think should be done? To go and regulate an audit with a team that is not competent, not that they are not competent, but it's simply that this is a specialized business. They are dealing with a specialized type of a product. What should we do? Should we resign and say no, gatiregere? Should we call the Mashiro Daiwa we are in? Should we say this team should be stopped and we find another team? So the most appropriate thing to do there, according to the quality standards, if the team is not competent, because it's a specialized field, we first of all provide them, we give them a pre-audit training. So we are going to, I think the best answer there is provide training to the team. So it is your duty to make sure you go with a competent team. Unless if it's of a specialized nature that they cannot be trained, maybe then if we have another team, we can go with another team. If we don't have another team, we can resign. But the first thing is to consider providing training to the team that you have. So right. Stega. Ndowona uzovarairoka musiematisiro pana riri panze munongorisa mukati riri panze pato munongorisa usiya pafloor cha mukadzika paground munongorisa mukati panoiswa mangu pana mavakati. Okay, let's move on. Can I remove that? So which of the following identifies the threats which could arise as a result of, is this still the same case? All right, let's move. Yes, which of the following identifies the threats which could arise as a result of the finance director previous employment? Let me just check something. I think, did you, in the Andambo, get this one? Which of the following identifies the threats which could arise as a result of the finance director's previous employment and recommend an appropriate safeguard? So we want the threat and the safeguard. So there is an issue there where they are saying the previous audit manager, who is a close friend of the new audit manager. The previous audit manager, who is a close friend of the new audit manager, left the firm. It's not just about leaving the firm. They left the firm and they are now the finance director of the client whom we want to audit. So what threat can that pose, and what can be a possible safeguard? B. Others, what's your check? I do support B as well. I do support B as well, because from the answers that we have, in the case, because if they are friends, it means there's a familiarity threat. It can arise from having a family member or a close friend working for the company that you want to audit. So I think there's a familiarity threat there. And as a result of that, it's better if we change. We can't have the audit manager being friends with the senior audit partner. So it's actually the audit manager being friends with the finance director, which is something that is likely to cause a familiarity threat. Since there are people that know each other, they might want to protect each other. So ignoring the potential effect of the total fee levels, match the non-audit service to the threat of independence which would be created. So we're ignoring the audit fee for now. Oh. Mm-hmm. All right. Ignoring the potential effect on total fee levels, match the non-audit service to the threat of independence which should be created. So let's match that. Oh, let me scroll down so that you can see the three issues. So let's match. What are you? So ignoring the potential effects of the fee, match the non-audit service to the threat, to the independence threat. So in this case, payroll, routine maintenance of the payroll records. The records, we need them. So when you're carrying out, when we are carrying out the audit, remember inspection, it has to be, we are looking at the records. So the payroll records, as long as it's a record, this one, it involves the amounts, the figures we have recorded. And if we are now the ones maintaining the payroll records, and when we are now agreeing the amounts akabadarwa, we have to also check the records. So I think there is a self-review threat. For payroll, I would say self-review. Services whereby S company would liaise with the tax authorities on behalf. So urikumirirwa client. So that's more of a lawyer, that's advocacy. Which leaves me with this one, assistance with the selection of new finance controller, including checking of references. Remember, finance controller are mari, and my auditors, they are also going to be paid. So they would find munhu kuti uyu ndewavo kana papa kubhadharwa tikati aiwa mari yedu ngaiwedzerwe uyu anobvuma asina complaint. So this one, yes, if we are recommending who should be the finance, tiri kurecommenda munhu wekufinance department and isusu tiri kuzobhadharwa necompany, would have a bit of self-interest there. So that's how I would match my threats. So let's, our time is now running out. Let's just quickly finish the section A. So we have two more questions. So which of the following safeguards would not be relevant in mitigating the threat identified of fees? Let's go back to the threat of fees. So there is the threat of audit fees, the last one. So which one would not be an appropriate safeguard to mitigate? So time is running out. Which of the following safeguards would not be relevant in mitigating the threat? So I think in terms of being relevant to mitigating the threat is the use of separate teams to provide audit and non-audit service. So why would this not be relevant? Because the issue is there is a fee dependency threat. It means company yenyu iri kunyanya kuona audit fees, iri kunyanya depend on this client for audit fees. And so if we use a separate team, this one is a safeguard inonyanya kushanda kana iri pa maybe self-interest or self-review. But kana takutarisa not self-interest inowanzoshanda kana iri self-review pa. But kana iri nyaya yekuti pane fees iri overdue, sorry, not iri overdue, yawandisa. As long as ari auditors are from the same company, it will not avoid that problem. Because tikati ngakuve team is straight futi, the still fees yacho yatirungowana irungoenda to the same company. So using different audit teams here would not solve the problem because the fee dependency, the audit client, the audit firm, it would depend on more zvakanyanya ne-client. So they are now afraid of losing this client. So even if we use different teams, fees still shouldn't end up to the same audit firm. So it might not avoid the problem. Let's have the last question for today. During the course of the audit of F company, a suspicious cash transfer has been identified. The audit team has reported this to the relevant firm representative as a potential money laundering transaction. Which of the following statements is true regarding the confidentiality of this information? Quickly go through that. Matukudi.
To be.
Yes, if there is a confidentiality issue, we are supposed, sorry, if there is money laundering, we are supposed to there is a mandatory disclosure. So if the client is into money laundering, there is a confidentiality under that case. So there is a legal requirement to report money laundering. And this overrides even the principle of confidentiality. So that is the structure of your section A. So the section B, for the section B, anenge